Hello, I've come to the Royal Mail head office to talk about flotations, which is the word used to describe companies joining the stock market. The government is soon expected to confirm plans to float Royal Mail, capping off what will be a busy year for companies listing on the London Stock Exchange. If the City of London were a postal worker, you could say the post bag he or she is carrying has got a lot heavier this year. The number of companies coming to market via an initial public offering, or IPO, has soared as stock market conditions have improved. 9 big flotations have swollen the ranks of the stock exchange's main market this year. Royal Mail's flotation, if it happens, will top the lot, valuing the business at around £3 billion. More are on their way as confidence in the economy grows. Reflecting the boom in house prices, Zoopla, the online estate agent, and Foxtons, its earthbound rival, plan to raise money by offering shares to investors. Also in the wings are Merlin Entertainment, the owner of Madame Tussauds and Legoland, DFS, the furniture retailer, department store group House of Fraser, and mobile phone provider EE. There have been more companies joining the alternative investment market, the junior stock exchange for smaller businesses. There are 2 ways companies can float on the stock market. Most companies go for a placing, in which they offer their shares to a small number of big city investors. It's a cost-effective but low-key way of coming to market. Sometimes companies want a bigger splash and go for a retail offering, in which their shares are made available to the public via stockbrokers. Either way, companies have to abide by rules set by the London Stock Exchange and the UK Listing Authority before they float. Companies that opt for a premium listing, which has tougher rules than a standard listing, are eligible to have their shares listed in the famous FTSE indices. Undertaking an IPO is complicated and can take several months. A company will hire an investment bank to oversee or sponsor the process. It in turn will pick other banks to be book runners, which means managing and attracting investor demand and helping to set the price at which the shares will be sold. Lawyers and accountants will also be engaged to ensure the company's finances and legal arrangements are in good order. Lastly, public relations staff are on standby to spin a favourable story to the press. At the heart of the process is the prospectus, which is a big document containing all the financial information investors need to know before they buy a company's shares. Ultimately, all this activity is good news for the saving public. New issues are the lifeblood of the stock market, providing investors and the fund managers who act on their behalf with opportunities to make money. But there's always a tension between a company joining the stock market and investors. A company wants to get a good price for its shares, but if it sets the price too high, investors can end up disappointed. This is what happened to Facebook when it floated in the US in 2012. Although the IPO was hugely popular, the shares slumped as the market took the view the social media giant's profits didn't justify a high valuation. Fortunately, such a flop is relatively rare, but it shows that investors need to take a good look at what tips out of the stock market's postbag.